Jerome is back. Yesterday, the Federal Reserve decided not to change its current rate, staying at a 5.25% to 5.5%. This tone is slightly different from September, by which the committee leaned strongly on raising the rate to 5.6%. It's not shocking or a blow to the head. Again, Jerome cites, although the data has been consistent, there has been no real negative or positive change. In other words, there's simply not enough information to increase or decrease the central bank rate. So what does that mean for you? That means mortgage rates shall remain at 7% to 8%, at least through the new year. So what's next? Hey, if you like the content, please like, share, and subscribe. For those of you who are still considering jumping into the real estate game, well, there is some good news, kinda, sorta. Stay tuned, and I'll go into more details about why you should be both excited and careful at the same time. Earlier this year, as a response to the increase in higher mortgage rates, FHA has or will be making a few policy changes. These policy changes are to encourage you to buy despite the higher rates and the lower inventory. One notable change is factoring positive rental payment history. This in the underwriting process. This could be a game changer for some. This is basically saying for those of you who may not have a lengthy or robust credit history, they will now include your rental history to make up. Number 2, FHA reduced its mortgage insurance. Mortgage insurance is a cost or fee that is added to the monthly payment. This is basically the insurance you are paying in case of a default. This allows your lender to cover any loss due to a foreclosure. The average estimated cost saving to borrowers is about $800 per year. In my opinion, this is a little bit small annually. However, it still has a positive impact on your annual operating expenses to run your household. For example, the $800 cost saving can now be applied to your car insurance. It probably won't cover the total premium, but it definitely will take a chip at it. So maybe look at it as an offset to your monthly expenses rather than a cost saving. Because guess what? You're going to spend that $800 anyway. During this uncertain time, over the next year, FHA is seeking to expand or encourage a few of its current offerings to you. One in particular is the 203K loan. This is how I got started, guys. This is how I bought my first rental property. Look, stay tuned to the channel. Elridge and I are working on a step-by-step guide on how to buy your first rental property. I'm sure you don't want to miss that one. Anyways, I digress. However, according to FHA Commissioner Julia Gordon, FHA is looking to improve the 203K loan and want the public to be more aware of this loan product. And that, my friends, means you. Just a brief understanding of the 203K. Let's be mindful. I got my loan back in 2004. So I'm sure some things have changed. But from the core of what I remember, it's an owner-occupied loan, meaning you have to occupy at least one of the units. You can use it to buy up to 4 units. That means you can buy a double, a triplex, or a fourplex. But that's not even the best part about this loan. The best part is you can use it on a property that needs repairs. So your construction costs, once the project is completed, will be added to the principal amount of the loan. Example, let's say the property costs $75,000 and the repairs are $100,000. Your total loan will be $175,000. And now wait, what every investor has been waiting for and what everybody's been talking about on YouTube is the Fannie Mae product, right? On November 18th of this month, in about 16 days, Fannie Mae will implement its new policy change. You can now get a Fannie Mae loan with just 5% down. It used to be an average of about 20%. This applies to owner-occupied 2 to 4 units. I have seen a lot, again, I've said this before, a lot of hype and a lot of excitement circulating around. While there is much to be excited about, is it really a game changer? So why am I drawing skepticism? Before I dive in, I want to say I'm not here to discourage you from moving forward. nor is it my goal to keep you on the sideline. The goal of this channel is to be transparent and to help you think things all the way through in order to get to the best decisions possible. So here's what I see. If less cash out of pocket is more important to you than the amount of leverage debt, then the 5% down option with Fannie Mae is definitely a game changer. This means you are mortgaging 95% at an interest rate in between 7 and 8%. For some, mortgaging 95% of the loan may not be ideal for their long-term investment goal. And they may consider putting a 20% down, thus mortgaging only 80% instead of the 95%. From a lender's perspective, the more you put down, the better it is for me. Why? That's because I have shifted some of the risk to you. You now have some cash in this deal, and you are less likely to walk away from the property when things get tough. So the 20% down is a win for me as a lender. Before you go and flag your mortgage broker down and jump all on this 5% down, let's consider some of the pros and the cons. The pros of the 5% down are: number one, it's less cash out of pocket. Number two, it's scalable. Now you can take that 15%, the difference of the 20% and the 5% is 15%. Now you can take that 15% that you would have saved, and now you can apply it on getting other investment property. Now here's some of the cons. Number one, it's less cash flow. In other words, the rent that you're collecting is going more towards the debt pay down than it is in your savings account. Number two, because your mortgage is higher, you now must consider a higher reserves account. Guys, you should have a 3 to 6 month of operating expenses set aside anyway, whether it's your primary residence or your investment property. This includes those mortgage payments. Now, when doing the calculations, it may not be a really big deal. I don't know. You got to run the numbers and determine what is more important to you. Cash flow more important, equity, or a combination of the two? Are you looking for long-term gains, or are you looking for short-term gains? All are very good questions you have to ask yourself. Hey guys, I only listed a few concerns. Of course, there are dozens of others, but for now, this is a good start as you weigh your opportunity to get started in today's real estate market.